Hi, welcome. Today in this video we will discuss about the monetary policy. So what is monetary policy? The usual goal of monetary policy are to achieve or to maintain full employment, to achieve or maintain a high rate of economic growth, and to stabilize prices and wages. Until the early of 20th century, monetary policy was thought by the most expert to be the little use of the influencing the economy and financial trends after World War II, however, caused government to adopt measures that reduced inflation by restricting growth in the money supply. Monetary policy is the domain of the nation's central bank, the Federal Reserve System, and the United States, and the Bank of England of the Great Britain are two of the largest such as banks in the world. Although there are some differences between them, the fundamentals of their operation and they are almost identical, and they're useful for highlight the variation measures that can constitute monetary policy. The Fed uses three main instructions in regulating money supply: open market, the discount rates, the reserve requirement. The first is far more important by buying and selling government securities, usually bond. The Fed or central bank affect the money supply and interest rate. If, for example, the Fed buys government securities, it pays with the check drawn on itself. This action creates money in the form of the additional deposits from the sales of the security by the commercial bank. By the adding of the cash reserves of the commercial bank, then the Fed enables those banks to increase their lending capacity. Consequently, the additional demand for government bonds speeds up their price and they reduce their yield. The purpose of their operation is to ease availability of credit and to reduce interest rate, which thereby encourage business to invest more and consumers to spend more. The selling of the government securities by the Fed achieves the opposite effect of the contracting the money supplies and interacting interest rate. The second tool is discount rate, which is interest rate of which the Fed lends the commercial bank. An increase in discount rate reduces the amount of the lending made by banks. In most countries, the discount rate is used as a signal in the change in discount rate will typically be followed by a similar change in the interest rates charged by commercial bank. The third to recall change is in reserve requirement. Commercial banks by law hold a specific percentage of their deposits and required reserves with the Fed or a central bank. These are the held either in the form of the non-interest bearing reserves or as cash. The Reserves Requirement Act has the brake on the lending operation of the commercial banks by increasing or decreasing this reserves ratio requirement. The Fed can influence the amount of the money available for lending and enhance the money supply. Historically, under the gold standard of the currency valuation, the primary goal of monetary policy was to protect the central bank's gold reserves when the nation balance of the payment was in deficit. An outflow of the gold in our nations would result. In order to stem this trend, the central bank would raise the discount rate and then undertake open market operation to reduce the total quantity of money in the country. This would lead to thus would correct the trade imbalance. The reserve process was used to correct a balance of payment surplus.